Hi, everyone. This is Rob Roy of Elliott Wave Options, and welcome to TradeFinder Live. For those of you that might be new with us, I'll give you a little bit of a rundown on how things work. First of all, we have this wonderful disclosure / disclaimer that we need to share with you. If you are a first-time viewer, please take a screenshot of it, read it in detail at your leisure. A couple things I want to highlight that the powers that be want you to be aware of. Number one, we are not registered to give individual investment advice in the United States. And because we have a lot of international viewers and international subscribers, any pricing that we're talking about is assumed to be in US dollars unless denoted otherwise. So those are two big things. While you peruse that, wanted to share something with you real quick. If you haven't watched our new S&P market update where we're talking about it's spooky out there, a little obviously a reference of moving into Halloween, but also with what's going on in the market. Are we going to get a stimulus? The election, is it going to be messy, et cetera, et cetera? And we're doing a giveaway where we're giving away 10 full subscriptions, both of our portfolios together, if you are a subscriber to the YouTube channel and post a comment. So I wanted you to be aware of that. If you haven't watched the video yet, if you're not a subscriber to the YouTube channel, hit subscribe, leave a comment. That puts you in the drawing. And in addition to that, we will be posting this recording as well. The contest goes until October 31st, Halloween. And so if you watch this video and post a comment under it, you are also registered and will go into the drawing for one of our 10 subscriptions. Well, that's 11 days from now. A lot of things can happen in the market between now and then. So if you choose to become a subscriber before October 31st, which I would encourage you to do so, because I think with the volatility, we're going to have a lot of good trades over those next 11 days. If you happen to win, we'll credit you for the win. They're quarterly subscriptions, so you'll get credit for it. You won't miss out on anything. And if you happen to be a current subscriber and you win, you will also get a credit. So we're not leaving out those that are current subscribers either. It's a random drawing. I mean, the power of technology, you can put names in there and do a random snake search, just like if any of you play fantasy football, whatever, same scenario. So it's at random, but we don't want to leave anybody out, but we don't want you to just sit around and say, well, if I don't win one of those, then maybe I'll subscribe. Well, you know, within 11 days, a whole lot of things can happen. So with that said, let's go ahead and take a look at the market itself. And here's the chart of the SPY. We had a bit of an intraday reversal yesterday, which moved to the downside. Back up today. The market does move a little bit intraday on the comments on whether or not there's a stimulus package. I just think that a lot of that is factored in. I think the market feels like there's going to be something. I don't think the market really cares whether it's before the election or after the election. I think there's just a view that we're going to get some sort of a stimulus package regardless of who wins the election. And if it's after the election, so what? You know, it's a month away. And then we're talking about more trillions of dollars coming in. The Federal Reserve is still constantly injecting money. I just don't think the market really cares that much about it. It makes headlines. And I don't know if you're like me, but I get tired of every single day the headline from the financial media of whatever the market's doing. Oh, if the market's going down, it's because, oh, there's diminished hopes of a new stimulus package. If the market's up, oh, there's increased hopes. It's just everything is wrapped around. Well, how about the market's just doing what the market does? Why can't we just leave it at that? And what the market is doing is actually quite fascinating. We talked about in the last market update how there was a new zigzag pattern to the upside. Well, check this out. With that move to the downside yesterday, we're at the 38% fib level, which is a better level to bounce from than where we were a couple days ago. So this just makes it that much better. I was actually excited that we had a little bit of a pullback yesterday. And with a 38.2% B-wave correction, that means that the next move is likely a 61.8% extension in the C wave, which does get us to new all-time highs. And then if that level's hit and exceeded, then we move up to a 100% if we do have an extended C wave. So just wanted to share with you that that was qualified. We still have that super cycle pattern that's right at that wave 3 extension. So if we fall from here, because other technicians could look at this and say, yeah, but look at this, you got lower highs. We do have lower highs. So with that, you want to take a look at the volume. But the volume is, you know, it's pretty choppy. That was pretty decent volume moving in here to that new high, and then moving down with that zigzag pattern that we had there was on good volume. Now we got a new zigzag pattern here to the upside. So it's a very difficult market as far as picking a direction from this point in time. Are we going higher? Are we retracing? Are we going back to the previous 4? Are we going further in the super cycle pattern? It's very interesting times, and that's where our volatility strategy comes in. Let me just show you a chart of the VIX, because somebody actually mentioned this in the last video. Actually, several people did, on the elevated VIX. And I actually highlighted this in the video, which is fascinating that that's where we are. Again, where are we in a trading range on the VIX? Back in 1999, 2000 to 2002, when the VIX was calculated differently, when it used to be calculated on the OEX instead of the SPX, it was the VIX was in an amazing trading range between 20 and 35. And you could set your watch basically on where the next directional move was going to be, on where the VIX was between that range of 20 and 35. It doesn't do that anymore. I don't know if they changed it because of that, because they felt like it was almost becoming too easy to figure out where the market was going to go. But this is the first time that I've really seen this kind of a trading range since then, where we have support at 25, we have resistance at 30, and we're just bouncing back and forth. So we're in a period of elevated volatility, but not extreme volatility, which is a perfect scenario for our strangles, because stocks are moving. Which direction do they go? We don't know. You know what? We don't care either which direction they're going to go. So this is just a wonderful time, and we'd love to have you come along as a subscriber, get involved in our strangles. You don't have to pick a direction in there. All we need is the stock to move. And with a VIX at 30, stocks are going to move. Stocks aren't going to just go dead sideways with a VIX at 30. It just doesn't happen that way. So I wanted to share that with you. Also wanted to show you a couple things that are really kind of head scratching in the market. And I see some questions popping in. I want to mention this as well. If you happen to be new with us, if you've been here before, you know how it works. But if you happen to be new with us, go ahead and leave your comment, and I'll get to the comments at the end. The way we do this is I start off by going through and doing this market review. Then we'll take a look at any closed alerts that we may have done in our website for our subscribers. Then we'll go back and review case study considerations that we've looked at previous TradeFinders. And then we'll go through and look at our current searches to see if we can find a case study consideration for tonight. And then with whatever time's left over, then I'll get to the question. So please know that if you're asking a question now and I don't answer it, that I'm not ignoring you. It's just that I lose my train of thought if I'm interrupting it chops everything up. It's not good for anybody if I'm constantly asking questions or answering questions throughout the presentation. So there's things that I want to get out. Let's get those out first, and then we'll answer the questions that we have time for at the end. So that's the process. But looking at this, you can see that the price on the 10-year is going down. Remember how bonds work. Prices and yields are inverted. So if prices go up, yields go down. If prices go down, yields and rates go up. So this is telling us that yields and rates are actually inching to the upside. And that's actually kind of a sign of economic health. You've got a Federal Reserve that's injected trillions of dollars into the economy. Congress put in trillions of dollars into the economy, and somehow we're finding a way for yields to inch to the upside. That's fascinating to me. It's mind-boggling. It gives you a little tiny piece in the back of your mind of, yikes, could we be looking at maybe, you know, real inflation or hyperinflation or something somewhere down the road? Can the Federal Reserve offset that if the economy does indeed improve and things get back to normal and the economy starts ticking again? With all that liquidity, you can see a scenario for inflation. So that's a little bit of a worry in the back of the minds. And then we take a look at copper. Wanted to show you this. We did a recording. It wasn't super well received, honestly. And I'm not sure if it's just because people don't really understand the ins and outs and the intricacies of copper, because everybody looks at gold and silver as the metals. Those are the two primary things. Everybody always asks questions about gold and silver, but rarely about copper. But we did a recording on our YouTube channel called Dr. Copper, because copper is more of a signal of underlying economic strength than gold or silver are. Gold is manipulated. The Federal Reserve shorts gold. Silver, that's why it has a better percentage return, in my opinion. But silver tends to trail gold a little bit, although I hinted at maybe silver is starting to take the lead based on the percentage movement. But neither of those matter. The one that really shows economic strength is copper. And look what's happened here. We had this, and I know that I've left these out, so you could go ahead and draw this way if you wanted and make it a far more extended ascending triangle. I wouldn't fault you if you wanted to do that. But I always look for where are the most number of touches on the trend line. That's how I draw the trend line. So I view these two moves here as a little bit of aberration. But look at what happened. We broke out. Will we get that follow through tomorrow? That's going to be fascinating to see, because if copper is breaking out, it is really hard to find an argument for any reason that copper is breaking out other than underlying economic strength. And if there is some sort of economic strength bubbling under the surface that we haven't experienced yet, boy, that could be great for the market. We could get a big move to the upside with all the liquidity. And then that's where the concerns for potential inflation would come in if that scenario indeed happened. Now, I want to just caution, we've talked about triangles an awful lot, and one day is meaningless. So that move doesn't mean a thing unless we get follow through. So we have to have a second day. We have to have a follow through or confirmation day. But if copper is taking off and goes on to some sort of a run similar to this, then, I mean, we had the big move to the downside. So copper just regained itself. But look, copper is above where we were before this big drop occurred. And supposedly I mean, think about that. Copper is above where it was before when the economy just shut down. So talk about economic weakness. We had more than economic weakness. We had no economy. Everything was closed down. And now we're back above that level. It's going to be an interesting next few months. So get through the election, whatever that is, end of the year, moving into the first quarter of next year. It's just going to be a fascinating time in the markets. So that's the primary thing that I wanted to share with you on the markets tonight, is the fact that yields are creeping up, prices are going to the downside. Copper is showing a really interesting signal as far as potential economic strength. And with this move that we had to the downside yesterday in the S&P, even better signal for potential upward zigzag. So all of those fascinating things that are going on in the market. Now we could go back to the spooky things where we could have a contested election. The election could be a mess. Maybe it runs smoothly. I don't think a lot of people are expecting that. That may be a surprise. I think most people are thinking that we're going to have, you know, a la the hanging chads in my home state of Florida and all the things that that we had in the past with the Bush election, et cetera. Who knows how things are going to play out from that standpoint. Do we get a stimulus package? How big is it going to be? We do have some spooky things that are out on the horizon, but the market's fascinating at this point in time. And I think the single thing that gives those that are looking for the market to move to new highs, in addition to these Elliott wave patterns, are the fact that there is still a great deal of retail money on the sidelines. There were estimates, I actually was reading about estimates in some financial papers over the last couple of days that only about half of the retail money that moved to the sidelines when we had the big move to the downside with the COVID crisis, the pandemic, whatever you want to call it, has moved back in. So still half of it is still sitting on the sidelines. Now, what does that mean? The thing that you want to take from that is the short sellers, you can hate them. They're necessary for the market, but they're also really smart. And the shorts tend not to step in a big way when there's half of the retail money on the sidelines. There's exceptions to every rule. So what I try to do is give you over 25 years of experience, what happens the majority of the time, what's likely to happen, and understand that I'm not always right. The market sometimes defies averages that's occurred in the past. There is nothing that's 100% accurate, but it would be surprising that the shorts come in a big way and really push this market down when there's still that much money on the sidelines. Maybe they do. It just would surprise me if that occurred. So from that standpoint, I think from a fundamental, which we don't talk about fundamentals much here at Elliott Wave Options, we're technical traders, but from a fundamental standpoint, that does lead credence to a potential move to a new high, even with all the spooky stuff that's going on in the market right now. So I just find it fascinating, and this is what I enjoy doing every day, is looking at these things. And you know, when people are just absolutely shocked at what's occurring in the market right now, I think that this is a time where it's exciting, in my opinion, to be a trader. Some people think it's scary. I actually think it's exciting. Anytime there's something a bit unusual, and it's a bit unusual, especially with this kind of a VIX right now, I think it's an exciting time to be a trader, especially an options trader. It's not that often that you find a VIX that's elevated and in a trading range like this, to where you can put on positions that are going to break out and break out nicely because of the elevated VIX, but the VIX isn't so high that the positions are too costly to take a look at. That happens sometimes. When you get the massive spikes in the VIX, well, the options become too expensive, and it makes, maybe at that point in time, putting on the strangles cost prohibitive. So you want to make sure you have a bunch of them on before that, so that when the VIX does spike up like that, you're just closing trades out and taking gains. You're not trying to put them on at that point in time. So it's an ideal time. And that's why I was saying that, yeah, we had this great contest, and it's been, I mean, the number of comments has been astronomical, but 11 days, you could make an awful lot of money in 11 days. So don't just wait for that to occur over this time frame. So we had a recent closed alert on NEO. So I thought I would share that with you. We just did a trade review on it. So it's actually on the website as well. But we'll go through and take a couple minutes to look through it at this point in time. Now, in talking about NEO, what's interesting about this is, I've mentioned this several times in the past, that GLD is one of those securities that consolidates, breaks out, consolidates, breaks out. And looking at this entry for NEO, take a look at the entry chart that was sent out. I should have given you the date first. On September 25th was the entry date. And we were involved in this pattern back in July. You can see we had an Elliott wave corrective triangle, and it kind of went sideways for a bit, an odd breakout, but then it exploded to the upside, which you would expect. And then we consolidated in another symmetrical triangle following that breakout. So here we had a little bit of move to the upside, boom, big vertical impulse thrust there, consolidating the triangle, went sideways a bit, tested, never broke below the point of the triangle, then the big impulse move higher, and then consolidation again. So is this going to be one of those securities that we watch in the future as something similar to GLD, which has a big impulse and then consolidates and has another big impulse? I hope so, because it's really fun trading a stock that's around $20 to $25 that has these kind of patterns. You can put on a lot of contracts. that way. So that was the initial entry. And then the exit was boom, here's the big move to the upside, boom, boom, 2 days in a row. Now there were some questions of, well, why didn't we close it out on the first day? We were starting to get a little bit overbought. Here we go. Say it with me. I don't even have to say that I say it all the time. Just say it with me. No security in any time frame gets very far away from the 10-day moving average. That's something that we look at a lot for when is it time to exit a position. So we had the big move to the upside. There was separation from the 10-day moving average, but quite often, especially when you're dealing with an ADR, a security that trades overseas, and NEO is like the Chinese version of Tesla. You get a second day of follow-through day because you have this catching up from what happened overseas to our market saying, oh, wow, look at that move. Let's get in too. So you tend to quite often have a second or follow-through day with a big move to the upside. So we waited for that and we got it. And now we're overbought. Okay, we were overbought the day before, but now we're really overbought. And it's time to go ahead and take that off. So look at where NEO was trading up there at just under 30. That was the exit, which generated 54% in just 19 days. Let's take a look at where NEO is at this point in time and see if the Monday morning quarterbacking aspect would be, okay, we did the right thing or not. Well, there you go. Look, so basically we got out. If you remember where the close bar was at the time when we closed it out, we got out near the high. And so boom, boom, boom. So we've had, it was technically a little bit of an upside on the 16th, but not from where we exited. From where it closed, it was, but not from where we exited. And then the next couple of days have been a little bit lower. So now it looks like we're going to consolidate again. I can already see kind of a formation of maybe another triangle. That would be great. Love to see it do it again. And so that we could get back in again. But that's the power of that 10-day moving average. That's why I talk about it so often. And you can see we still haven't fully closed the gap there. We're coming down a little bit. Maybe we just go sideways and consolidate it and let the 10-day moving average catch up. And if we form some sort of a Elliott wave triangle, we'll be back in it again. But it's fascinating to see how that plays out. But you're also getting another example of why that rule regarding the 10-day moving average is so important. And it just shows up and it works that way time after time after time. It's a rule. And we just did another recording for our Elliott wave course on flats. Not my favorite strategy. Flats are not my favorite strategy to trade. But it's really important to understand all aspects of Elliott wave. And you want to understand the mechanics of a flat, because if you're thinking that maybe you're in a zigzag pattern or maybe you're in a 5-wave impulse pattern, is it one of those, or are we in a flat? Because there's signals that will tell you that's not a directional 5-wave or zigzag. The signals are telling you we're forming a flat. So I don't like to trade flats, but that doesn't mean that it's any less important to understand what flats are, how they're forming, because that ties into what I do like to trade, which is the 5-wave patterns, zigzags, especially zigzags within the wave 3 is really one of my favorite things to do. And then of course the triangles, which a lot of comments on the last YouTube video were regarding loving the strangles, loving the triangles. So I think that's been an eye-opener for a lot of people of how you can identify these Elliott wave corrective triangles and make money and not have to pick a direction. Boy, doesn't that take a lot of stress off of you as a trader? If you can identify a pattern and all you need the stock to do is move, there's 3 things a stock can do, right? Up, down, or sideways. Well, if we take 2 of those away, up or down, meaning that we'll make profits, there's only one way you lose. So if you get down to the point where the only thing that beats you is if the stock goes dead sideways, and with the VIX at 30, what is the likelihood of a stock going sideways? See how that puts the percentages in your favor of being able to generate a gain. And by using the math that we do, by creating our own unique strangles and putting the math for the creation of the delta formula, gamma, etc., in our favor to make sure that if the stock does move, we have a position that will make money as fast as mathematically possible. So, you know, it's just fun. It really is. All right. So that was the one that I wanted to share with you. And you know, we'll come back next week maybe and look at this again and see if we're forming another triangle. But we took a look at, let's see, 2 weeks ago, we looked at MPWR. And I mean, if you didn't take the profit last week, what are you waiting on? We're going dead sideways now. I'm not going to say it again, but there you go. With the overbought condition being satisfied, you probably would have gotten a better price to have exited it last week with that big, huge vertical move, because going sideways like this takes some of that IV spike out of the call options. But, you know, you've got plenty of time to take your profit if you haven't already. And I know some of you have been in that one because you actually messaged me about it. PayPal was another one that we looked at last week. We actually did send this out as an alert to our subscribers. And boy, take a look at this. I hope you're starting to see patterns this way where it's not very big. Granted that it's what was the low is 198 and the high is 209. So it's about a 10-point wide triangle there, but PayPal's getting ready to move 10 points. I don't know if it's going to be up or down, but it's getting ready to break out from that move. And you can say, well, you're in a wave 5 to the upside. It's breaking to the upside. Not necessarily. Remember that in Elliott's world, the corrective patterns take precedent. So whether you're in a zigzag pattern or a corrective triangle pattern, it takes precedent. We could move 10 points to the downside here, and it doesn't change a thing from the wave 5 move higher. We're still, it wouldn't disqualify it at all. Not that big of a deal, a 10-point move in a $200+ stock. But it's setting up nicely. Look at the DMI. Now that tends to give a bit of an idea of what direction it may be. But again, you don't pick and choose the direction when you have a triangle. But the DMI looks good. We're sitting here with positive directional indicator, negative, and the ADX moving to the upside, breaking higher, still between those two. That looks good. It's telling you that that trending move, although we've had a little bit of consolidation over the past week, but that move's still strong. And remember that the DMI is measuring the strength of the move. It's not telling you whether or not the stock is going higher or lower. It's telling you the strength of the current move. The positive directional indicator is telling you, yes, right now the buyers are in control and the sellers are weak, and the ADX moving to the upside measures the strength of that trend. But it doesn't measure direction. It measures strength of the current move. But that still looks pretty good. And then, boy, BIDU. Did you watch this one? Holy cow. The next day after last week, did you see what happened? Did you follow this? Boom, look at that move to the upside. $9, it broke out. Now it opened down here, and if you would have been quick and gotten into it, it had a big, massive move, but now look what's happened. So if you're looking at that and you were thinking, doggone it, I missed it, with that big breakout move, well, here we are, right back to the point of the triangle, and look at today's bar, a doji. So you got another chance to get in this one if you're interested in following along with this. No follow-through day. That's amazing to me. So this is the stuff that I find fascinating about the markets. Come back over here and look at this breakout day. Okay, so we had a big breakout day here on the 15th, follow through on the 18th, which was the following Monday, and then the 19th, another follow through. Boom, boom, boom. 3 days to the upside, which we actually had that, by the way. Our subscribers were involved in that. And then here we are back to a really nice ascending triangle, about as nice of an ascending triangle as you can find. Quite often I talk about really well-formed symmetrical triangles, and I don't usually praise an ascending or descending triangle as being that well-formed. But in this case, that's a really good one. amazing to me that there was no follow-through day. A breakout day like that without a follow-through is fascinating. But again, that's why I enjoy every single day trading, because you just see things that either you haven't seen before. Even after 25 years, I still see things I haven't seen before, or you still see things that make you go, wow, I would have not expected that. So that keeps things interesting. But here we are at a doji right at the point of the triangular breakout. So we broke out, no follow through. We came back. We're testing the breakout point. This could turn around and explode to the upside, where we have another day like we did on the 14th, last Wednesday, or we could have this being a complete total head fake where it sucks people in on that big move higher, and then the big breakout move is actually to the downside. So this is actually still in play. It would have been difficult to have entered it after that day last Wednesday, because that would have caused a great spike in the call options with that move. But the fact that we've settled back down and now we have a doji, if you look at the volume, I was just going to say that I have a suspicion that with the doji we had weaker volume, and we did. So you got a good volume. I mean, there was volume backing that move, and it didn't, that did just, you would have looked at that and said, there is no way this stock is not off to the races. It would have been hard with that volume spike buoying the big move in price that stock wasn't going to take off and run, but it didn't. That's one of those things where you're just like, wow. It's a wow moment in the market. So a low volume doji at the point of the breakout, you're getting a reprieve. If you didn't take advantage of this one, you've got another opportunity too. A couple other ones that we said we wanted to keep an eye on. So you might have to refresh my memory on these two. So Spotify, we were watching, and we had really good consolidation. We did have a breakout. That breakout was that was Tuesday when we were together. So I don't know, not a whole lot's happened. What were we, somebody reminds me of, oh, were we waiting? That's probably what we're waiting on, to see if the ADX was going to break up. It hasn't yet. So that's why I'm not more familiar with it. It hasn't given us a signal. And then the other one that we were looking at, I remember somebody asked a question about this, Workhorse. Ooh, wow. Now we're setting up, which I don't think this was probably the initial thought process in this. There is a really not, and again, this is an aberration day. In my opinion, it's meaningless because we have really nice lower highs. Other than that, we have a support level right there at 21, which has been resistance from the end of June, July, and August. Now you have the triangle pattern, which wasn't what we were originally looking at, but did we look at the options? I don't remember if we looked at the options to see if this was liquid enough. Let's take a look, because that could be interesting too. Let's see where the DMI is. Probably too high. Oh, it's diving down though. Getting awfully close. Remember, we like to see the ADX below 15. If you've been with us before, you know that that's one of the things that we watch for in creating these. Did we talk about this divergence last week? I know I did in one of the recordings, where you had the high here in July, and you had a new high there in September, but you had the ADX making lower highs. So that was a clear indication that that move to a high in September did not have the strength to it as the new high that did back in June. So there's divergence for those of you that like MACD type of stuff. I prefer just to look at them, find my own divergence things. So MACD is not one of the indicators that I look at often. So let's take a look and see what the options look like on Workhorse. There's good liquidity there, even out to January. and it's not that expensive. So there you go. That's pretty darn interesting. Like to see the ADX just a touch lower, but now we're setting up for, let me see, can I make a note of that? At this point in time, I'm going to look at this tomorrow, just adding this to my own personal watch list at this point in time. And yep, I still write things down on a piece of paper. I know that there's 9 million ways that you can create spreadsheets and stuff and input stuff and automate it and all that kind of stuff. I leave the automation to Elliott Wave software. That's where my automation is. I'm still kind of old school on a lot of things. So I just still go through pieces of paper. I go through tablets. I don't want to get them for you, but that couch that's behind me has a whole stack of tablets underneath it where I still write, still make notes and still write watch lists and things like that on tablets. So make fun of me, I don't care. That's still the way that I like to do things. So pretty interesting. So last week, looking pretty good. PayPal hasn't done anything yet. We'll see which way that goes to break. PayPal's earnings are November 2nd, so there's still about 2 weeks before their earnings report. See how the stock trades into that. And let's go ahead and take a look at our current pre-computed list, see what we can find for tonight, and then I'll answer some questions. 4-0 on the corrective. Wow. Isn't that interesting? You know, you can tell a lot just from looking at the results. I know I've mentioned this before, but I'm going to do it again. You can tell a lot from just looking at the results of our pre-computed searches. And if you're wondering, well, what is that? Well, for our subscribers with Elliott Wave options that have ProfitSource, we have included basically they're my search parameters. So our subscribers can follow along, and they quite often do, and they ask questions. And it's a learning experience for our subscribers where maybe there's something that shows up as a result on that list, but it doesn't get sent out as an alert. And so we'll ask the question, well, why was XYZ that appeared on the search, why wasn't that sent out as an alert? And then I can explain to them why it didn't qualify, even though it was a search result, because remember, a search result is just a starting point, and that's a learning experience for our subscribers. So anyway, the fact that there's 0 in the corrective movement and there's 4 on the impulse, just look at that. So what we've done now is we've taken 4,000 plus now optionable issues in the market, and there's only 4 that we want to pay attention to. And I know that there's other stocks that are moving directionally, et cetera, but based on our indicators and our success rate has been pretty darn good, there's only 4 that meet the criteria that I like to look at to see what's going on. So the first one is Magna. FIZZ, I've always liked that, the symbol on that one. So let's take everything off here except for the DMI. See, and you've heard me talk about this before too. Those of you that are new, I really like to see the ADX drop below 20 when it starts to move back up. DMI, hardcore, buy the book rules guys would tell you 25 is good enough. I like 20 better. I've already set the DMI parameters because I've changed it to 13 here. I've already set it as a touch more aggressive. I like to see it drop below 20 and watch when it breaks above 20 instead of 25. So I would have preferred that. It doesn't exclude it from consideration. It's just a personal preference. We talk about in our Elliott Wave education rules and guidelines. And so the fact that the ADX didn't go below 20 doesn't break a rule, but it is something that I prefer. So more of a guideline type of thing that I'd like to see it come below 20 before it moves back to the upside. So then from that standpoint, we add the Elliott Wave on. Are we likely to continue higher? Well, we just broke this recent high that occurred back on August 11th. So you can see here is where the breakout occurred today. And remember, one day doesn't mean anything. So we have to see what happens tomorrow. So right now we're looking at a 54% extension. The other thing that you could be looking at here is that's a flat right there. So are we extending the C wave on the flat, or is that flat done and we're starting a new impulse move, which may very well be what's going on? So we had this corrective flat in the wave 5, so it's a complex wave 5, and now we're breaking to the upside, and maybe we're off to a new impulse run. That's pretty interesting. Actually going to make a note of that one too to keep an eye on. We have traded this in the past, but let me just take a look at the options real quick. And it's not super liquid. There's enough, but it's not great. It's not bad. It's not super liquid, but it's tradable. And that's kind of what I remembered from the past. So that's pretty interesting right off the bat. And then next is Serve First Bank shares. Now here's where I was going back, and this is the reason that I wanted to show you where bonds were and the fact that rates are kind of inching up. There could be some surprises when the financials report their earnings this quarter. That just the, a little bit of a tick up in rates makes a big difference in the financials in what the returns could be. So we could be looking at a bit of a surprise. And then looking at this, looks awfully like a 42. Yeah. So we're almost there already. And wow, boy, that ADX tried to get down there. Then it got 2 different times right down to 20. Just couldn't break it either time. It looks like maybe it wants to go this time. Look at the volume spikes. You got volume supporting it. And if you wonder why I put volume on the charts, yes, I love Elliott Wave, and I really love our set of confirming indicators that we use in our trading system. But you're crazy if you ignore price to volume action. It's been a basis of the market since day one. And you need to take that into account in whatever technical trading system that you have. Price to volume action matters. So there was volume behind this move. We're breaking, trying to break, couldn't hold it on the close, trying to break to a new high. And if we do, then we're most certainly going up to that 43 level. It's not a huge move from 40 to 43, but it's likely that's going to happen. I've never heard of this before, so I'm questioning how liquid the options are. Yeah, not very, which makes a lot of sense. So forget that one, but it's still good technicals on the charts. Here we go. National Beverage, FIZZ. You just got to love that symbol. It's almost like they had a little bit of a sense of humor when they were creating their option symbol. So not sure what was up with the TMI there. There must have been something really unusual in the past. So a little bit of a gap up. This could be viewed as kind of a defensive play, figuring that, well, regardless of what happens, there always was this view of the SEN stocks, tobacco, alcohol, and gambling, as that's where money goes to hide when there's uncertainty about the economy, figuring people are still going to find a way to drink, smoke, and gamble, our vices, regardless of what's going on in the economy. We'll figure out how to do that, so money tends to go and hide there. And you might wonder, well, why are there defensive sectors? And that's because based on money going in through monthly payment plans, dollar cost averaging, if you will, through IRAs, 401ks, or retirement programs, people are putting away money every single month. By prospectus, a high percentage of that money has to be put to work. It's got to go somewhere. It can't sit in cash. Some of it can, but not a lot of it can. So they got to figure out where to put it. So if they're nervous about putting it into high beta stocks, then they put it into something that's viewed as, all right, well, it may not be the sexiest stock out there, but it tends to do okay or outperform, if you will, when the economy is not doing well? Well, you could argue that with soft drinks too, couldn't you? People are still going to find a way to go drink their Cokes and everything else, even when times aren't so good. So breaking to that new high today is fascinating. Except it's only one day. You need the second day. The only problem is the ADX is already pretty high. It looks good in the fact that it's still between the two directional indicators. The positive directional indicator is off to the races. The negative one is like, yeah, we're out. The shorts are saying we're done. So it could very easily go up and hit that 100 mark, and trading at 88 is probably highly likely that it would, but that's probably the end of the move. We could get up here to 93, and you know my whole Star Trek theme of if you get that high, the tractor beam effect of moving to a big whole number like 100, this seems to attract it, and that's dead in the middle of the tap box here on the forecasted wave 5. So it'd be very difficult to believe that we're going to make it to 94 and not just go ahead and hit 100, and that could probably coincide with this DMI saying we're overbought, we're done, that's the end of it. But you need one more day. Well, how far does that next day go? Does that, I mean, because the high of the day today was 89. And so we're talking about 94 to 100. Is that still enough to put on a trade? It would have to be ultra liquid in order to do that. And it's not. I mean, there's some liquidity there, but it's not ultra liquid by any way, shape, or form. So I don't know if, with all things considered, that's enough move to make that one worth it, but it's a pretty interesting looking chart. And then Bank of Hawaii. So here's another financial, and that's got to be interesting too, because I'm sure you've been watching the news where Hawaii just reopened, right? They had pretty strict guidelines on travelers coming in as far as the COVID restrictions, et cetera, but they've opened up, they've made it easier. If you fill out all your paperwork and have everything on your phone before you get there, then they'll do a test as soon as you land, and within an hour or two of landing, you're on your way. Well, it wasn't like that before, but that's kind of where they've gotten. So will the Bank of Hawaii benefit from the economy in Hawaii getting better? You would think so, right? So I'm making a fundamental argument, right? So, which is not the thing that we usually do here. But it's never bad to have great technical patterns backed by fundamentals. That's the way we use fundamentals at Elliott Wave Options, is we use them as a foundation against our technicals. They're not the decision-making aspect, but they're in the background. And if you have a bullish-looking chart and all the technicals are in place for a stock to move to the upside, and that company is backed by good fundamentals, that can't be anything but a good thing, right? And are you seeing this? I mean, do I have to draw this for you? Hopefully you saw this already, that there is a really nice zigzag underway at a 47% B wave correction, which means 100% extension. So yeah, it's not much of a move though, is it? So from 57 to 60 is probably going to happen. That looks awfully likely. Great looking DMI. There's my ADX under 20. So loving that. This is what I like a DMI to look like. So great support there. Now we could also get that 161.8% extension, which would bring it maybe up to, you know, more towards those most recent highs back in May and June. Still not anywhere near where it was before the whole COVID thing happened. I really like this one. Let's see what the options look like. I think this is the best of breed, if you will, the best one. Oh man. That's where trading gets frustrating, is you find a chart that you just can't really find a reason to say no. And I talk about that a lot too. When we're trading, you don't look for a reason to put on a trade. You look for reasons not to put on a trade. And if you can't find a reason not to put on a trade, that's a trade you put on. And so this just looks really good across the board, but there's no liquidity. You can still trade it. The spreads aren't that wide. So let's talk about that from a standpoint. This could be one that we look at, but you have to know you're trading with the market makers, okay? Because there's 47 contracts on the 23 delta going out to January. You can go up to a 39 delta, but you're getting too close to at the money. I just wouldn't mess with that. The 23 delta is good. It's $1.05 by $1.30. That's not that bad considering there's only 47 open contracts on that strike. But no, with just that few number of contracts, you're trading against the market maker. The market maker doesn't want to take risk. The market maker wants to close orders, buy and sell, take the spread. That's what they want. So if you're trading with them, now they have to go offset the trade. So if you're curious as to how that works, when I say you're trading with the market maker, they're not going to take a directional position against you. They don't do that. It's dumb for them to do that because they're guaranteed to make the spread every time they execute a trade. They don't want to take a directional bet because if they're wrong on their direction, then they could wipe out a whole bunch of those spreads that they collect just from filling orders. So what they will do is if you're trading with them, they're going to go offset that trade with somebody else. They're going to find somebody else to take the other side of that. And because it's so thinly traded, now it's more difficult for them to do that. Point being, you're going to lose the width of that spread. You're going to pay the ask and you're going to sell at the bid. So there's no splitting the spread is going to occur on that trade. I mean, they set the spread, so that's what they're willing to do, but you're going to pay that. So you're going to give up 30 cents going in and probably at least 30 cents going back out, which means 60 cents is gone before you even consider putting the trade on. And if you're going to put on a trade where you're going to pay $1.30 and you already know you have to make $1.90 just to break even, it kind of changes the dynamic a little bit, doesn't it? It makes it, yeah, I don't know if I really want to do that or not. Especially when we're sitting here at 57 and our target price is only 3 points away. You're probably not going to be able to make enough on this trade to justify spending 60 cents on commissions. So hopefully that was a little bit of an insight of how things go when I talk about, oh, you're trading with the market makers. Well, that's the way that works. So it's a shame. I think the stock's going to probably hit its target. I think it's going to do really well. I just don't think we can make any money doing it. You know, it's likely going to go hit its target, and you don't make any money even if you're in that trade. So I guess I don't know that this is kind of a rare day. I don't know that we can actually kind of come up with if I do any more, I can't take any questions. We're likely going to look for. Let me do this real fast and see if there's any results here. All right, there's only two. Let's look at them real quick and let's see if there's something that we can find with the consolidating stocks that are still in a bullish Elliott wave pattern. Yeah, not excited about that one at all. The DMI is not there. That might be something down the road, but not today. And then Trimble, actually have traded this before. Yeah. DMI is low, but there's not really. I think you could kind of stretch this and say, well, you got a little bit of an ascending triangle there. If we connect those highs and then we have a really nice set of higher lows, that part looks good. I think the resistance is a little bit weak, but that may be the best one of what's out there at this point in time. So let's see what this looks like. For the good thing about it is at least it would be a strangle, which we've been talking about the power of those. And there's no liquidity past November. Good liquidity in November, but that means it has to move this month. That's not enough time. That's not enough time for a breakout. So I think we're just going to have to say we will allow MGA to be our case study for this week if we get a follow-through day tomorrow. So that's going to be a question mark. This is a first here, I think, where we haven't really found a great one to label as this is our case study for the week. So I'm making a note of that. Question mark needs a follow-through day tomorrow. So it could qualify tomorrow, but not today. All right, so got time for a few questions. Do I see a triangle forming on the SPY? I think it's too early yet, but there could be one forming. So good on you for starting to look a little bit early and seeing patterns develop. I like to see that you're starting to see that. I think there's more work to do if we're going to develop a decent triangle. Just not enough touches of that upper trend line. Yeah, we have a pretty good vertical set of higher lows. So I imagine that's something that you're looking at. It's not bad. I just think that maybe we could do a little bit more work. And if it does churn a bit sideways over the next, say, week or so, we could form a much better looking triangle, but that's not a bad spot. So good question and good looking at that. I just don't know that it's one that I would do just yet, but it could get there. Guys, why is the B wave called treacherous and the most difficult to trade? The other ones we'll look at, because you're a subscriber. Let's look at those Thursday night. They'll be on the list Thursday night, so if you can just hold those to then. We'll cover those. But the question on the B wave is good for everyone, which is the fact that why is the B wave treacherous? It's the key, isn't it? And you're going to see more of that. I mean, you're leading me right into our new educational series on flats, where we actually talk about that situation with the B wave, because the B wave gives us a lot of information on whether or not we're moving into a flat or a zigzag pattern. So even if you have a flat, you're probably going to get a directional corrective move back up or down, depending on which direction the A wave was in the C wave. But it then becomes, what kind of a flat are you in? Because there's different kinds. You don't have to necessarily be in a regular flat. There's a couple other types of flats that we concur where the C wave is different lengths. So it doesn't necessarily give you a target length in the C wave. So I appreciate you asking that question, because again, that's the information you're going to get out of our new educational series on flats. So the B wave is treacherous because it's key. It's hard. We don't know. The B wave can come down, it can hit a fib level and bounce, but we don't know for sure it's going to hold there. So if you step in and you're trading it as a zigzag pattern, because say the B wave corrected 61.8%, which I love, and I'm willing to take that risk on the B wave bouncing off the 61.8% level and continuing up to 100% extension, but you don't know that for sure. It could be a bounce off that support and then come down. And then if the B wave corrects 70%, well, now you just violated the zigzag pattern. So the B wave is iffy, and it's key. It's the key to the whole thing. So it's a really good question. Volume on the SPY. Yeah, that's pretty tiny, isn't it? Well, the data that comes in on the SPY, I may not have refreshed it in time to get that before we started. So yeah, that may still be from earlier in the day before I came on. So good spot there. But regardless, tomorrow means a lot, because right now we're in this little bit of lower highs, aren't we? Even with today bouncing back, still lower highs, and you want to see that break. That's actually, if that was the triangle that was asked before, that's a little bit better triangle than the one I drew the first time. Do I ever spread strangles? Brian, what a good question. Were you, you must not have been on the one where we talked about the twin zigzags. That's the way that you could take a look, and we just haven't talked about that too much because we haven't shared that with our subscribers yet, and we don't show them, or we don't send out alerts on stuff that they're not educated on. That's just not the way we do things. We don't want to send something out and have our subscribers say, what is this? We want everybody to be fully on board. We're as transparent as we can be. So we send stuff out that, you know, that we've done education on. And, you know, the opportunity for twin zigzags is not that high. You don't get great triangles like this on super high flying stocks with super high volatility that often. It just doesn't really happen. This happens to be one of those opportunities. So you're right on that. And, you know, perhaps you weren't on one of the classes where we talked about this before, because before this, like last week, literally, that's one of the best symmetrical triangles you're ever going to see, especially when you come down and look at the fact that the bottom of the triangle is right there on top of what was resistance for nearly 2 months. It's just as good as it gets. So we had a breakout, and now we're back testing that breakout. So it begs the question again, was that a false breakout? Are we testing it, and then we're going to move back to the upside? Or was this a head fake to get people to buy in, and then the big move is going to be to the downside? But the way you set up the twin butterflies is you put one up here in this area with whatever your breakout perimeters are. And I could run the numbers, but I'm just not going to do it in the essence of time right now. Up there, and you put one down here with the forecasted breakout move. And because both of those butterflies are out of the money, they're very inexpensive considering the Tesla stock. So if the stock were to break out and move up into this butterfly, this one's a loser, right? That's 100% loss. But the profit that'll be made here is greater than the loss that would occur there. And it doesn't even have to make it within the wings. Just getting the direction right, this profit will offset that loss. Now, these aren't going to be home runs because it's similar to the Strangle type setup where you're buying one call and buying one put. One's making money, one's losing money. Similar scenario. The potential, however, if you get the timing right of the twin butterflies versus the traditional Strangle of buying a long call and buying a long put, if you can get the stock to stay in those wings somewhere near 10 days or less to expiration, well, now this becomes that home run grand slam scenario. This one's 0. Now you've had a really nice gain. That's where you could hit a really big winner on the twin butterflies on the breakout. You can still make a profit. It doesn't have to be within the wings near expiration, but in the wings near expiration is where the home run potential gain comes from. Just getting the direction right, and you're going to get the direction right unless Tesla goes dead sideways, which I don't think anybody thinks is going to happen, is going to work out well. So November looked like a really good time frame to do this. Now the fact that we've had a false breakout and we're coming back and testing it, had you gone out to December, that may work out well because maybe it's going to take longer than initially looked to get there based on this test. If it's a false breakout and it moves to the downside, then November is going to be best. But if it tests this and then it turns around and it does move back higher, December may very well work out to be the best scenario. But yeah, spreading out and a butterfly is a spread. I mean, let's be honest, it's actually a combination of two spreads, a long call and a short call spread, a long put and a short put spread to the downside. So good question. Why is zero corrective and 4 impulse fascinating? What makes it so? Steve, I just feel like with where the market is right now, with the set of lower highs and the fact that this peak here on the 12th of October is lower than that one there, you could make an argument that we're in a corrective move back to this previous 4. And because of that, I mean, you would expect there to be none on this way up, but moving down here, you would have thought that there would be some, even if there's more that are potential zigzags out of stocks like there is in the SPY, with this being a qualified zigzag now, you would have expected to see, in my opinion, I would have expected to see several candidates for corrective moves with that pattern. So the fact that there's 0 with this week-long lower highs and the fact that that peak up there on the 13th was lower than the peak back on September 1st, it just seems like it's an ideal setup for a number of Elliott wave corrective patterns. So the fact that there's 0, I just found surprising and interesting. I hope that makes sense. What do I think about selling short-term calls and puts against the strangle trades to reduce costs and increase profits? Whew. You know, there was a guy that used to do, in fact, he was in Australia. He was famous for doing short strangles where he would sell the options way, I mean, further out of the money than we go, right? So he would sell them. So the idea there being you go way out of the money. And he made a great living at this for a long time, where you go way out of the money, you sell the call, you sell the put, and you expect that the stock is just going to stay in this range. Even with the breakout, he didn't necessarily do triangle patterns. He looked for elevated volatility. Kind of a little bit of the same thing, right? Because if the volatility is elevated, there's a move expected by the market makers. So we would try to capture that premium by selling a short strangle, but doing it super wide. And it worked great for, he made money for a long time and then got blown out. And I don't like selling naked options. You can justify the, the probabilities of it staying within those wings. And even if it's 98%, I don't like that 2% chance because it's unlimited risk. It's unlimited risk on one side and it's almost unlimited. It's really substantial risk on the other side. And one bad one can wipe out a whole bunch of good ones. And that's the same thing with people that get caught up in selling naked puts, just selling naked puts. You know, it's great marketing. And if the market is continuing to march straight to the upside, it works out well. But then you get something like COVID, and you know how many short put sellers got wiped out through here because it all started up again. Because look how long the market went to the upside before then. So all the naked short putters, put sellers were coming out of the woodwork again. And there they had a 6-month run, 7 months where they made a ton of money. And it was gone in less than 2 months. It's just more risk than I'm willing to take at this stage in my life. But I know a lot of people do it. So, I mean, I get the question. I understand it. You gotta trade with an iron stomach and trust that you sleep well at night. Craig, is a liquid stock high open interest? Kind of two different things there. A liquid stock is considered good volume. It trades a lot of shares on a daily basis. High open interest goes to the options. So are the options liquid? And I may use some slang terminology that may be confusing at times, so I apologize if I've done that. When I'm talking about liquidity of the stock, to me, I don't even think about buying the stock. So everything is option based to me. So when I'm talking about is it a liquid stock, I'm already referring to is there liquidity in the options, meaning is there high open interest? Are there a lot of people trading the options? So if that terminology was a little confusing of, well, is he talking about the stock or the options? I apologize. I get that. Just understand that I'm an options trader. I don't buy stock. So I don't ever really, other than looking at a chart of volume here to see if there's volume supporting a move or not. When I'm talking about liquidity, I'm talking about in the options. So thanks for asking the question so I could clarify that. How much liquidity is a ballpark? A general rule has always been you want 100 contracts or more in an option strike. That could actually be viewed as being maybe a little bit on the low side, but that would be a minimum 100 contracts of open interest on the strike price that you're looking to trade. At least that gives you an opportunity that maybe you're not trading against the market makers. And so you have a better chance then of getting filled somewhere between the bid and the ask, the midpoint, if you will. And Apple, we'll take a look at Apple and then we'll wrap things up. So let's look at Apple and then we'll call it a day. I run long every time. It's unbelievable. I can talk. That's all there is to it. But look at this. I love talking about this stuff. I actually glad you asked that. I didn't really realize that Apple was in such a nice, that's a really good triangle. Let's see where the ADX is. Yeah, it's not quite low enough. That's why it hasn't shown up on the search. But boy, it's getting awfully close. Holy cow. Well, we don't have to look at liquidity here on this one, do we? Everybody knows that there's liquidity in the options of Apple. Yeah, I mean, it's just off the charts. Boy, I don't know that we're going to get the ADX to dive low enough for that to show up on the search. But that one actually could work anyway. I'm just looking to see what it would cost if we could do it where it wasn't astronomically priced, and you could. Yeah, you could go out to December or January. January would be better, and get in the neighborhood of a 20 delta, which 25 is ideal. That's right in the sweet spot of the delta curve. 20 is not too bad for a stock that can move. And Apple, after the split, doesn't move quite as well as it once did, but still, you can see still has movement to it. So I think I would prefer the extra time going out to January on this. And if you could do a 20 strike call, or I mean a 20 delta call and a minus 20 delta put, and still keep it around $500 of risk, that looks pretty darn attractive. Again, it hasn't shown up on our search because the ADX isn't just quite low enough yet. And just as one last piece of reference, the lower the ADX, the closer to a breakout you are. Doesn't mean a stock can't break out with an ADX below 15, happens all the time. But the lower the ADX goes in a well-formed triangle, the closer you are to a potential breakout. So the negative when you're putting on the strangles as we do is that the stock sits there sideways for a while because that's chewing up time. So we try to, we hope to get these as close to the breakout point as possible, because the sooner it breaks out, the more money that we're going to make, and we don't have to lose time value. But it's inevitable after you put the strangle on. We talk about this with our dot plot daily mark-to-market graph. The next day you're losing money. You're losing money the next 5 minutes after you put it on, because there's already been a tiny bit of time premium that's been taken out of it. It's just the nature of the beast. But if you can get it to move, then you're good. And that's actually a pretty decent looking one. I mean, Apple we talk about all the time from a directional standpoint, but that's a great looking strangle. Thanks for your attention tonight, everybody. Have a great week. Talk to you again next week.